Test 1, 2, 3.
Good morning, everyone, trustee and staff. It's 8 o'clock. We can start
Recording in progress.
And would like to call for the credit risk mitigation meeting in order. Linda, can you please take the roll call?
Sure. Thank you, Chair Mee. This meeting is being conducted as a virtual and in-person meeting. So we'll do a roll call of trustees to confirm attendance. Ms. Mee?
Yes.
Mr. Rue? Ms. Martinez? Ms. Martin?
Here.
Mr. Jones?
Present.
Okay, staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, Chief Counsel Stephen Rice, investment staff Vache Masarigin and Kwok Wen, and we have consultants presenting. We have the Alborn team presenting today. Please use your raise your hand option to be placed in this queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. You can proceed with the agenda.
Thank you, Ganta. So the next item on the agenda is approval of minutes. Do any trustee have any question or changes to the minutes? No? Okay. If we don't have any change, then I can get a motion, a second approval of the minute from anyone. Second.
You want to do a motion?
Yeah.
A motion?
Yeah. I'll second. So,
Thank you.
Okay.
All right.
Okay, Miss Me,
Yes.
Miss Martin,
Yes.
okay, and Mr. Jones.
yes.
Okay, and the motion passes unanimously.
Thank you. Next item is the report. Today we have a presentation from Vacha called, please correct me if I didn't say it right. Clark. Thank you. And our consultant, Alban, Steve and Travis to do presentation on hedge fund education. So the floor is all yours. I'm ready to be educated. Thank you.
Good morning, Madam Chair, committee members, and trustees. Today's presentation is the third in a recent series of educational sessions. As you recall, in March, Stepstone provided an overview of private equity, and in April, Allborn presented an introduction to real assets. Today, the spotlight is on hedge funds. As you know, LACERA's strategic asset allocation has an 8% target to hedge funds, representing 1/3 of the 24% allocation to the risk reduction and mitigation functional category. Allborn has returned today to provide an overview of hedge funds. To my far left is Travis Williamson, who's head of hedge fund research at Allborn. Next to Travis is Steve Kennedy, a senior consultant on our account. As you'll hear from Travis, hedge funds are a heterogeneous category of investments representing a wide variety of strategies and risk profiles. After Travis's overview of the hedge fund universe, Steve will review the different categories of hedge fund mandates, and he'll discuss LACERA's implementation approach. He'll also present our program's performance. Afterwards, my colleague Kwok will cover the goals and objectives of LACERA's hedge fund program, and he'll provide additional information on our realized risk and return. We hope you find this presentation to be both informative and interesting. So without further delay, I'll hand off to Travis to begin our review of the hedge fund landscape.
Great, thanks. Thanks for having me here. So yeah, as an overview, I'll outline the industry, the landscape, where it was and how it's evolved, talk a little bit about evaluating hedge funds, and then I'll pass it on to Steve to talk about hedge funds and portfolios. We'll just wait 1 second for the slides to come up.
Yeah. Sorry, can we load the Allborn slides, attachment 1, please?
Here we go.
Great. How should I advance them? Sure, Melissa, if we could go to the next screen, please. And the next one after that, please. Yeah, great. Great. So just as an introduction, wanted to give an overview of sort of how the hedge fund industry has evolved. As you can see there in the plot of hedge fund AUM, there's been quite a steady evolution. And this really chronicles the institutionalization of the industry, you know, starting from a fairly small business type of an industry. It's really evolved into wholesale, full industrialized, institutionalized industry over the last 30 years. I think it's important to understand hedge funds is a broad term for a very heterogeneous group, as Vache outlined. There really are a lot of vehicles, a lot of strategies, a lot of sub-strategies that can fall under this umbrella, and we'll talk a bit about that as we go forward. But some of the unique characteristics that hedge funds brings is the flexibility, the ability to be opportunistic, to be nimble, and to find niches that other traditional structures aren't able to provide. But with this degree of heterogeneity and potential complexity comes the need to understand and understand how to evaluate and have a framework for doing so. So next slide, please. Be a good time to discuss some of the utility of hedge funds, like how are they used, why are they important to institutional allocators? And it's, again, they can provide a portfolio risks and risk profiles that you might not be able to find elsewhere. They can have niche investment objectives that can really add in a portfolio context, which will be discussed later. They can also protect investors from certain market risks that you may want to mitigate given the goals that you have. And then from a timing perspective, they can provide a long-term portfolio structure such that market timing is less of a concern, as that's traditionally very challenging. And again, niche opportunities. This is a nimble group of investors that can go into obscure areas of the market that, again, can add to a portfolio's return profile. Next slide, please. So here we want to introduce some of the taxonomy, and sort of we've talked about how it is a broad umbrella, heterogeneous group, but this is how we begin to map out the landscape into these four quadrants. You'll see that there's a delineator there, high leverage, lower beta. The beta is referring to the relationship to risk assets in this context. So, let's think of the S&P 500 or the MSCI World. And the desire to have a statistical relationship of a certain profile to those can be really important and can very much direct your allocation process. So just real briefly, relative value strategies really tend to be market neutral. Pick the market that they're involved in, whether it's fixed income or equities. They're really intending to have a lower directional relationship to that asset class. Directional or macro strategies are really planning to or aiming to capitalize on that, on the asset class, the movements within the asset class that they're involved in. So you're really getting that directional exposure into the portfolio. Event-driven can be somewhat niche. This can be very large-scale M&As, or it can be niche debt restructurings or activism, as you're well aware. And then equity long short is fairly straightforward. These are fundamental stock picking groups. They can be quite focused in very niche areas as well, but they can also be very broad, and having the ability to vary their net exposure, how long, how short they are, can give them a lot of latitude in what they provide to a portfolio. Next slide, please. So here we're adding some degrees of definition and complexity to our understanding here. So building on the framework at the top of the page, we want to add some of the characteristics here in the lower half and just bring to life some of the characteristics that you'd get in these four broad quadrants. So return expectations in terms of volatility profile, correlation, how are they traditionally correlated to the underlying markets that they're taking exposure in. The variability there, we're speaking to within that group of risk-taking entities, what is the variability of the profile they're in? Leverage, as you would imagine, is something that you want to understand as it relates to the strategy and how it's being executed. And then for tail risk, we're thinking of left tail within a return distribution, so unintended negative consequences and how one might want to think about those as it relates to the strategy. And then liquidity risk, certainly something that is important to understand. What is the liquidity risk being taken by this cohort of managers, and how should it be factored into the overall liquidity needs of the portfolio? Next slide, please. And of course, please jump in with any questions if you have any. So hedge funds can often have a risk modulating role in portfolios, balancing, if you might. And we wanted to exhibit how that can, or how that has realized over time, and how it might affect going forward. So there's a lot on this page, so I'll just walk through it real briefly. On the left side, the y-axis, you have returns, as is clear, and then you have specific events outlined there on the x-axis. Where I would direct your eye is the light blue bar and the dark green bar. So the dark green bar is the MSCI World, and then just for context, Hedgers EW Universal. That's Hedgers is Allborn's index. It's something that we've maintained for many years now. We use it for benchmarking. There's full transparency and constituents and whatnot so that you can fully understand what exactly that is. Universal is as it would entail just the whole industry. And so it's just a broad swath. And then EW stands for equal weighting. So within the indices, you could do asset weighting or equal weighting. This is equal weighting for greatest simplicity, and you're including the broadest swath of large and small participants. The Barclays Global Ag is a fixed income indice. And so what we're really trying to display here is the hedge funds performance in these periods. So these would be what you would call left tails broadly, relative to unhedged assets, whether it's the broad equity universe or fixed income. Next slide, please. And so here we're zooming out a little bit in terms of, this is 22 years of return data, showing how hedge funds have behaved relative to other assets and other benchmarks again. So what hedge funds aim to do, and what we would posit that they've shown to do, is provide attractive risk-adjusted returns. The idea there is you get the full return, but at reduced risk. And so looking at the left-hand chart here, so you have risk versus return. So, and the axes are clearly labeled. You can see that you're getting the majority of the global equity return, but at a third of the annualized volatility. You can see the groupings of the dots versus the MSCI World over there at the 15% annualized vol. Another way to look at that is the beta versus Sharpe. So beta is, again, the relationship to the underlying asset class that is being where risk is being taken. So typically in these scenarios, we're looking at equity markets. And then the Sharpe ratio is a ratio of risk to return. And so you want a high Sharpe and you want a low beta. And so that's where you can see on the right-hand chart, you kind of have to look hard, but the MSCI World is all the way to the lower right, meaning you get all the risk and modest return relative to these broader strategies. And again, this is 22 years of real data here. Great. Next chart, please. Again, here we're trying to illuminate the relationship of volatility within the hedge fund universe relative to unhedged asset classes. So you have the MSCI World there on the left in the light green and then the dark green. And so here to an extent, you can see, again, just you're getting the return profile of these broad asset classes, but with much less risk. And that's the intention. That's the value proposition that hedge funds are intending to bring to portfolios like yours. Next slide, please. And so with all this going on with hedge funds, the breadth of strategies being employed, the complexity therein, you really have to understand, how do we evaluate hedge funds? What's the process? What do we need to understand? And one way to summarize this is we're looking for alignment of 5 characteristics: the experience of the investment team, the process of the investment team, the collection of risks that they accumulate, or call it a portfolio, how those are risk managed, and then the outcomes. So when we were looking at performance, we were looking at the outcomes. And then we as a team work with your team to evaluate those who are taking the risk. What are they bringing to the table? How are they executing their strategy? What transparency are they providing us such that we can understand? It's one of those, it's quite seductive to look at a track record and think, oh, this looks really great. But if you don't understand why they're doing well, you're not going to understand why they're doing poorly when that time comes, and you'll have nothing to stand on. So it's really important to have that transparency, to have that deep understanding of who in the organization brings what skills, how are they being executed, such that if anything changes, whether it's performance or team members leave, that you really have that full understanding of how they're doing what they're doing. And operational due diligence is extremely important to that as well. I sit on the investment due diligence side, which is about what I just explained, but operational due diligence is really about, can they prudently execute the strategy that they're intending? Is there any risk in their organization that you're not being compensated for, and understanding that? So that's of paramount importance as well. And I think I have one more slide. If we could go forward one more. Risks in sort of, risk monitoring, measuring, and managing. It's obviously extremely important. After this starts before you make an investment, but certainly is paramount after you make an investment. And what I would suggest here, the way Allborn looks at this, is these 5 pillars of risks, meaning you need to look at them in relationship to each other. For example, liquidity and concentration. If you have a lot of liquidity, you might be more tolerant of concentration in a portfolio if that is part of their intended strategy. But if that liquidity profile changes and the concentration remains, you may not be tolerant of that exposure from the manager, or at least you'd have certainly something to discuss with the manager as to what's changed, why, and how. And so we spend a lot of time here. We have a lot of people working on this, and we communicate regularly with your team on this topic, as it's of paramount importance here. We have a lot of tools to analyze these data. There is a lot of data that comes from the manager, which is important, and we triangulate that with other sources, and we certainly triangulate that with the outcomes. If we know they have an exposure and that exposure goes up, we want to make sure the P&L goes up, and we triangulate that through exercises like that, but also third parties who verify the data. It's mentioned here, open protocol data. This is an initiative that Allborn has championed. It's open source. It's not ours, but we've championed it. And that's a standardized exposure reporting framework. So it's not position level, which some managers are reluctant to provide, but it's exposures, meaning are they exposed to North American TMT equities? And you can understand what that might mean. And the beauty of this is it lets you and us aggregate those risks across managers. Each manager has their own brew of how they look at risk, and that's very valid. But when you bring a portfolio of them together, you need to be able to aggregate them, and this provides that. So it's a tool. We have over 3 trillion hedge fund AUM providing us these data, which allow us to look at the broad landscape as well as individual funds with great detail. Probably gone over a little bit, but let me know if there's any questions. Otherwise, I'll pass the mic to my colleague Steve.
Great, thank you, Travis. If we could go to the next slide. So as Travis outlined and Vache also touched on, the hedge fund universe has a wide variety of different strategies. So diversification is obviously one of the larger goals with a lot of portfolios, trying to diversify against the traditional asset classes that are held in equities and fixed income, and trying to achieve an absolute return within a portfolio. Looking to provide downside protection is also a crucial role for many portfolios, in particular for LACERA, really trying to emphasize strategies that are robust and a portfolio that is diverse in terms of the strategy mix and implementation. And obviously also alpha sources. So as Travis alluded, there are a lot of different things that you can do in hedge funds, a lot of different things that can be traded, portfolio structures, and putting those together can provide alpha sources that are differentiated from other parts of the portfolio. If we could go to the next slide. So a few typical examples of portfolio structures are risk mitigating, which is where LACERA sits. Those that are a little bit more balanced and looking for allowing a little more equity and or credit beta, a little more concentration, a little less liquidity. A portfolio that isn't going to be quite as robust in an event period like some of the ones that you saw in a few of the other slides. And then return seeking, where you're really taking on more equity and credit risk and directionality in those markets, a lot more beta, a lot less defensiveness in terms of the portfolio structure. So LACERA is really focused on that risk mitigating left-hand side, really wanting the portfolio to be robust, diverse, and be able to stand up in different periods of stress. So that's where the staff has really put all the effort to make sure the managers in the portfolio are providing that kind of return profile. If we go to the next slide. So as the structure review in 2020 in particular really helped to solidify the goals and objectives of the portfolio, really focused again on those top 4 areas: reducing total fund risk, providing diversification, providing downside protection, and low sensitivity to major markets such as equity and credit. So the structure review led to a reconfiguration of the portfolio, identifying some of those strategies that Travis laid out that are more defensive in nature, have less equity or credit beta to them, and can provide returns even in adverse market environments, such as 2022, where the portfolio was up despite equity and bond markets being down. So the overall, in the spring of 2020, the portfolio started adding managers that were more conservative in terms of deploying across different strategy sets, more focused on relative value strategies, and subsequent to that, to macro strategies that were able to trade around different market moves across equities and fixed income markets, as well as FX. If we go to the next slide.
Steve, quick question for you.
Yep.
So if the strategies that we have are meant purposely to kind of work against adverse movements in credit in the equity markets, then during times of say good performance in those markets, is that strategy then considered neutral? Is it performing poorly, or what is it doing when things are trending up relative to that?
Yeah, so the portfolio is in particular skewed towards some of the relative value strategies and the macro strategies, de-emphasizing the event-driven and equity long-short. Those strategies overall, I mean, there's diversity in those in terms of how they're implemented. Some are lower net, some are longer net, more concentrated. Those are the ones that are going to have a lot more sensitivity. The relative value strategies are more market indifferent. Not always perfectly market neutral, but generally fairly market neutral. So they're just trying to take advantage of relative mispricings in related securities. So even when markets are up, those mispricings are still there. So the return profile tends to be quite steady. So a couple of the managers in the portfolio, in fixed income trading, really steady returns, market indifferent generally. And then in terms of the macro managers, they're able to get directional. And in 2022, what really benefited the portfolio, some of those managers being able to be short rates. So when bonds were selling off, that was a big positive, aspect of the portfolio in terms of differentiation. So this portfolio, you can see the portfolio is outpaced, over the trailing periods against its benchmark, as well as HFRX as representing the broader hedge fund universe. And this is with the benchmark, obviously, is a cash plus benchmark, which in the last couple of years has become a little bit higher rate of return, obviously, with the Fed moves in terms of the increases and then subsequent to rate decreases. But even with that, it's keeping pace with a benchmark that is cash plus 200 at this point. And then the last slide. So I think this one visually can help illustrate what has happened in terms of the portfolio. The orange bar is the equity markets month by month, and you can see, sometimes quite dramatic drawdowns in those indices. And what you see with the blue is that this portfolio has been very steady and positive in the up markets. To your point, they participated, but not because they're taking equity or credit beta on a directional basis, but just based on the nature of the different return sources within the portfolio. So they've been quite defensive, but they also have generated positive returns also in those up environments. But really, you can see the defensiveness when equity markets have been down. And again, the portfolio was really started being reshaped starting 2020. So since then, you can see there's very few instances that the portfolio has actually been down. And when it has been, it's been incredibly modest, even in some pretty tough equity markets. So I think staff has been really purposeful in terms of the strategy mix and the manager execution and focusing on those risk factors and understanding all the different moving pieces in the organizations that they've deployed capital with. And with that, any questions?
Thank you for presentation. I do have a question to help me understand this a little bit more. So you talked about earlier that hedge fund is not an asset class. And does it mean that outside equity long and short, I know equity long and short is just 100% stocks, right? Outside that category, is it everything else is a mix of any asset class in a hedge fund?
Yeah, hedge funds. Sorry, I'm muted. Hedge funds do participate in every asset class. Equity long short managers that are focused on equities are probably about a little over a quarter of industry AUM. But other managers, so like a macro manager who may normally trade FX and rates, would also trade equities. You could have an infrastructure manager who also trades equities, as well as owning the physical infrastructure. I'm not sure if that's your question, but there's usually a strategy that then could entail multiple asset classes under it. Versus, but while there are some that are asset class specific, if I'm getting the gist of your question, sorry.
You did answer my question, yes. So it's a mix, some of them equity, some of them just mix up any possible asset class in their strategy. So I see how this is how the low risk has been, like they can achieve that low risk because of that diversification there, right?
Exactly, yeah. And then the mix therein is how, Steve and your team put it together to make the mix of managers for your purposes is really important too, because you have so much to choose from. Choosing becomes really important.
Right. And we have our own target purpose of this whole hedge fund program. I have the pleasure to meet with Vacha and the team a week ago, I think, and learn about the history of our program. It's a young program, but very accomplishing. I think we chose, the right purpose, what we want this asset class, this hedge fund to function in our portfolio, right? We want risk mitigation, and we'll achieve that. In addition, I see, return, as well. So, yeah. That's all my question for now. Thank you.
All right. So for this next section, good morning, Chair Me and committee members. For this next section, can we pull up the attachment 2, please? So while that's being pulled up, I'll just mention that this part of the education item is to build on top of Travis and Steve's comments. But to also provide additional context and insights into LACERA's hedge funds implementation and portfolio outcomes. As of March 31st, LACERA's hedge funds portfolio stood at $6.3 billion in net assets. It is currently 7.8% of the total fund, compared to that 8% policy target that Vache mentioned. And then tying this back to what Steve and Travis mentioned, there's a large universe of hedge fund strategies and different ways that investors can implement a hedge fund program. So in the lower left graphic, we added a snippet from the board-approved risk reduction and mitigation structure review. And similar to what Steve said, it shows various types of hedge fund programs, ranging from a risk offset to a risk mitigation to a return enhancement type of program. And then also, like Steve mentioned, LACERA does not have a risk offset program, which is very similar to like an insurance policy where you pay periodic premiums and expect to get paid off when a big negative event happens. We also do not have a return enhancement program that can take big swings and strive for equity-like returns. Our program sits between those two variants, which we call an absolute return risk mitigation program. It strives for consistent singles and doubles, using a baseball analogy. It seeks non-directional and uncorrelated returns, and this profile aligns well with its role in the total fund. As Vache mentioned, it sits within risk reduction as a functional category, along with investment-grade bonds, long-term treasuries, and cash. Now, in the upper right box, we added a snippet from the investment policy statement. It describes performance expectations of the hedge funds portfolio, which is to produce returns at or above investment grade bonds with equal or lower volatility and be largely uncorrelated with other portfolio assets like equities. So if we can switch to the next slide, please. Thank you. So this slide has a lot of information. I'll walk through the various components. In the middle, you'll see a diagram that our team calls the hedge fund's honeycomb. It was pulled directly from the risk mitigation structure review. In the perimeter of the hexagon, it describes important attributes that we seek in hedge fund strategies. Similar to what Steve mentioned, strategies that are frequently positive, have low sensitivity to major markets, and providing downside protection to the total fund. The combination of these attributes, we believe, improves the probability of achieving those desired outcomes. And then we added charts on the table to the slide to show how the portfolio has performed relative to those honeycomb objectives. And starting from the upper left, the histogram of monthly returns over the past 3 years shows that the hedge fund program has been positive in 83% of the monthly observations. Now, in comparison, global equities were positive 61%, and investment grade bonds were positive 47% of the months during that same period. The chart on the lower left shows historical drawdowns of the hedge fund's portfolio in that green line compared to the various major market indices, including global equities in black, credit in light purple, and investment grade bonds in red. You'll see that the green line mostly hugs the top of the chart, showing that the portfolio has experienced shallow drawdowns compared to the other 3 indices. This portfolio has provided downside protection to the total fund. Another desired attribute is to have low sensitivity to major markets. This means having a portfolio beta and correlation metrics closer to 0 than to 1, similar to what Travis mentioned, compared to global equities, credit, and investment grade bonds. And why compared to equity, credit, and bond markets? These are the assets that LACERA has meaningful exposures to elsewhere in our total fund. So returns that have low beta and low correlation to these markets add valuable diversification benefits. In the upper right table, you'll see that over the trailing 3-year period, the hedge fund's portfolio has exhibited low to no beta and correlation to these 3 markets, while at the same time delivering steady upper mid-single digit returns across all time periods, as you can see on that table immediately below. 0 beta and delivering between 6 to 8% annualized returns is one of the outcomes that the team is most pleased with. Also noteworthy is that these annual returns compare favorably and compete with LACERA's actuarial return target of 7%. And lastly, if we can go back to the previous slide. Thank you. And I'll just mention again the performance expectations of hedge funds, which is to outperform investment grade bonds with equal or less volatility and be largely uncorrelated with other portfolio assets. And if we can flip back to the last slide, thank you. That's exactly what you see in the 3 tables to the right, highlighted in those green dash boxes. LACERA Hedge Funds has delivered 6.7% in net annualized returns since April of 2019, while investment grade bonds have returned 1.4% over that same period. So the program has delivered 5.3% more in annualized returns compared to investment grade bonds, with roughly half the volatility and low correlation to equities, credit, and investment grade bonds. So with that, I'll pause here and stand for any comments or questions.
Yeah. So question. So with the program having been relatively young and its initial focus on since 2020 on your risk mitigation piece, and this may be kind of an obvious question, but I'm still unsure of it. Would across our portfolio, would we run multiple outcomes-based hedge fund strategies? Like we start out with risk mitigation over some piece, but would the team envision at some level there being a return enhancement, or do those cancel out each other? Or how do we look at this and say, good program performance, good advisory work by Alburn, it's doing what it's supposed to do over the last 5 years. If there was a question about expanding it beyond in some other different application, how should we think of that as a board?
Sure, I can respond to that in feel free to chime in. So as part of the strategic asset allocation, hedge fund sits within the risk reduction functional category. So as a profile, that is how staff and along with our consultants design the portfolio to achieve those specific objectives to help benefit the total fund the most, given the total strategic asset allocation. We have growth drivers within the total portfolio, private equity, global equity. So as far as a return enhancement role, right now, that's not the role that hedge fund kind of plays. In the future, to the extent there's different asset allocation mixes that the board may consider, I don't know if there's a variation of hedge funds that might be considered as part of a different role, but that might be.
So again, relatively unsophisticated question. So you couldn't have a segment where I understand that it plays a risk mitigation role, it's doing its job, it's performing whatever else. If you were to add another strategy in a different part, can you only have one hedge fund kind of strategy function across the entire portfolio? Can you have multiple kind of ones? Again, I'm not sure if I'm framing the question correctly, but do you get it what I'm asking at?
And through the chair, I hope everyone can hear me. Words matter and nomenclature matters, and that Travis started the presentation saying hedge funds aren't an asset category. Hedge funds are a structure, an ownership vehicle, a fee structure. And as such, we have firms across the portfolio that operate hedge fund type strategies in other asset categories. So and this is something that we look at in structure reviews. We've had public equity strategies, more activist strategies that were managed by hedge fund firms that we discontinued because on a risk-adjusted basis for the objectives of that asset category, we did not think that we were being compensated. So we exited those strategies. In credit, we have many strategies currently by firms that may be deemed hedge funds, and other plans may put them in a hedge fund portfolio. But many of these firms have hedge fund type strategies, but our implementation in credit is not may differ such that we may not call them hedge funds, but the firm itself may qualify as a hedge fund, may be in Alborn's open protocol universe as a hedge fund. But I think a lot matters in terms of the naming convention. And I think that we're focused more on the portfolio implementation and less so on how a firm may call itself or identify itself.
No, great. Thanks for the distinction. I appreciate it.
I was thinking, thank you for the mic. I was thinking similarly, how do we come to this conclusion of picking to have hedge funds to play the role of risk mitigation? I'm thinking as if a big picture of a whole LACERA portfolio. And then I know recent years we have transitioned from asset class to functionally category, right? Is that after the transition, and is it a strategy that we come about to think that this is the best role that this can play in the overall portfolio?
I think
I was just going to say, given that that's in some sense a total fund question, I would say that as the numbers show here, it's something that I don't like to do. I'm not kind of a hype person, but it's working really, really, another comma, really, maybe another one, really well in that. And this is something that the board, it's a board decision based upon strategic asset allocation. We run different scenarios with different asset categories. And within that strategic asset allocation exercise, we have different assumptions for the component parts of those asset categories. And this is something that this implementation is working for us. And I think that the role of long, short, or relative value or event-driven type of strategies in other asset categories are things that we look at as it relates to those structure reviews. But the purpose of this is to discuss the absolute return risk mitigation hedge funds that we have, and its target 8%. We're at 7+% today. And it's something that the board at the last strategic asset allocation increased the allocation because it is working so well. So I know the team is too humble or modest to say it, but I'm going to add another comment. It's working really, 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 really well for us.
That's how I thought about it. That's what made me kind of ask the question, how do we do more of it?
Right.
Congratulations to the team. Appreciate it.
Cannot agree more. It's working really, really, really well. So let's keep it going. And I agree with what I believe it's Travis said that, right? When we come to manager selection, it's important that we understand, their strategy behind and then who they are, right? So they have something that we can fall back onto. Solely depends on the track record. It's like we always say in investment, past performance does not guarantee future success. So that's how I feel about our team as well, to getting to know the entire team, meeting everyone and understanding how they do their job. So as a trustee, that give me confidence, not solely just was told it's working in the past, so more than that. So I appreciate, every one of you, what you do, and you're so, I observe the interaction among the whole team. I really like it, the culture that you have there, that everyone's so open, to hear any different perspective and so collaborated. And then I hear different perspective there, and then the teamwork there, and great leadership there watch us. And then thank you for that meeting I had. And with that, I want to ask anyone else that have question for this team. No question? All right. If there's no question, I can move on to the agenda next item. Thank you. Thank you again. So, Linda, do we have any items for staff review?
No, we don't.
No item from anyone? Okay. Is there any item for future agenda from anyone? No. And if that's the case, let me know if you have anything you would like to share in the good of order. When we can start it from.
Other than just to restate, Chairman, just great job to the hedge fund risk mitigation team, Vache and Kwak and the team. So
yeah, and Trustee Kathy. Yeah. Thank you. Thank you. No, okay. And Trustee Ru, anything? No. All right. So and then that will be good. The order. I'll call
Can adjourn.
Adjourn. Perfect. Thank you, everyone. We'll have a nice break before.
and then we'll start the main meeting right on time at 9.
Yes.
Recording stopped.